Homeowners insurance is becoming a larger part of the cost of owning a home. For many households, the pressure does not arrive through a new mortgage. It arrives through a premium increase, an escrow adjustment, or a higher monthly housing payment. A homeowner may have the same house, the same loan, and the same basic budget, yet still pay more to keep the property insured. Housing affordability is not only about the sale price of a home, it also includes the costs attached to staying in that home: mortgage payments, property taxes, utilities, repairs, and insurance. Homeowners insurance is often treated as a secondary cost. The verified data shows it is becoming harder to ignore. Pew Research Center reported on May 6, 2026, that 71% of U.S. homeowners said the cost of their homeowners insurance had gone up over the last few years. 42% said it had gone up a lot. The survey was conducted from March 16 to March 22, 2026, among 3,524 U.S. adults, including 1,236 homeowners who were asked about home insurance costs. That is the household warning. Most homeowners in that survey said their insurance costs had increased. For middle-class households, a higher premium can reduce room for groceries, transportation, utilities, savings, repairs, or other monthly expenses. The economic chain is clear: higher repair and rebuilding costs, higher disaster risk, insurer losses, and risk pricing place pressure on insurance premiums. Higher premiums raise the cost of owning a home. When insurance is paid through escrow, those higher costs can appear inside the monthly mortgage payment. The final impact reaches the household budget. The issue is not that every homeowner is affected in the same way. The research shows large differences by region, risk level, income, zip code, state regulation, and insurance availability. The direction of pressure is clear. Homeowners insurance is becoming a more visible part of housing affordability. The warning has been building for years. The U.S. Department of the Treasury's Federal Insurance Office reported on January 16, 2025, that homeowners insurance was becoming more costly and harder to procure for millions of Americans. That report covered data from 2018 to 2022 from more than 330 insurers and more than 246 million homeowners insurance policies, aggregated at the zip code level. Treasury found that average homeowners insurance premiums per policy increased 8.7% faster than inflation during that period. Treasury also found a large gap between low-risk and high-risk areas. Consumers living in the 20% of zip codes with the highest expected annual losses to buildings from climate-related perils paid an average of $2,321 in premiums. That was 82% more than consumers in the 20% lowest climate risk zip codes. Risk pricing by location makes insurance costs higher in places expected to face larger losses. The household impact is that two homeowners with similar houses can face very different housing costs, depending on where they live. Treasury also found that policy non-renewal rates were about 80% higher in the highest risk zip codes than in the lowest risk zip codes. Homeowners insurance pressure is not only a price issue, it is also an availability issue. A homeowner can face a higher premium. In some areas, the homeowner may also face difficulty keeping coverage at all. For households, that creates uncertainty. Insurance is not optional for many homeowners with mortgages. The Consumer Financial Protection Bureau explains that many homeowners pay for homeowners insurance through an escrow account, as part of their monthly mortgage payment. The borrower pays the lender holds the insurance portion in escrow, and the lender pays the insurance bill when it is due. That connects insurance directly to monthly housing costs. If the insurance portion resays, the homeowner can see a higher monthly payment even when the mortgage principal and interest payment has not changed. The home loan may be fixed, but the housing cost can still move. This is why insurance has become a hidden housing cost. It can rise inside the payment structure homeowners already use. It can appear after a household has already planned around a mortgage. It can make the cost of staying in a home less predictable. The pressure is not evenly spread. On February 27, 2026, GAO released a report titled Homeowners Insurance. Premiums generally tracked inflation but rose more in disaster-prone areas. GAO found that the average U.S. homeowners insurance premium rose 3% from 2019 to 2024 after adjusting for inflation. At the national level, that sounds moderate. The same GAO report found that premiums increased 25% or more in parts of certain states, especially southern coastal areas with high wind risk. National averages can hide regional stress. A homeowner in one part of the country may see a manageable increase. Another homeowner in a higher risk area may see a much sharper rise. For those households, insurance can become a serious part of the housing affordability problem. GAO also found that premiums as a percentage of 2023 median household income were highest in Florida, Louisiana, and Oklahoma. Affordability is not only about how high the premium is, it is also about how that premium compares with local incomes. A $2,000 premium does not carry the same weight for every household. The burden depends on income, other housing costs, and the ability to absorb increases. The research also shows how risk affects pricing. GAO found that homes in areas with severe or extreme wind risk had premiums about 58% higher, or about $1,294 more per year, than similar homes in areas with major wind risk. Homes in areas with severe or extreme wildfire risk had premiums approximately 8% higher than similar homes in areas with major wildfire risk. The measurement and pricing of risk raises premiums in riskier areas. For homeowners in those areas, the result is a higher annual cost simply to maintain coverage. Risk is not the only factor. The data shows several pressures. Pew asked homeowners whose insurance costs had gone up what they believed were the major reasons. 65% said insurance companies wanting to make more money was a major reason. 61% said repair or rebuilding costs were a major reason. 46% said extreme weather events were a major reason. 28% said government regulations were a major reason. Those Pew findings reflect homeowner perceptions. They are not proof by themselves of insurer, profit margins, or any single cause. They do show how homeowners are experiencing and interpreting the increase. Repair and rebuilding costs are central to the economic chain. When labor and building materials are more expensive, damaged homes cost more to repair or rebuild. Higher claim costs can place pressure on insurers. Higher insurer costs can feed into premium requests. Higher premiums flow into household budgets. Treasury's data supports the link between risk and claim costs. It found that claim severity averaged about $24,000 in the highest risk areas, compared with about $19,000 in the lowest risk areas. Insurance premiums are tied to expected losses. If claims are more severe in high-risk areas, The insurance system prices that risk into the cost of coverage. The effect reaches homeowners through the bill. The household may not track claim severity or expected annual losses. It sees the premium. If the policy is escrowed, it sees the monthly payment. The issue also reaches lower-income homeowners differently. Pew found that 80% of upper-income homeowners, 75% of middle-income homeowners, and 54% of lower-income homeowners said their insurance costs had gone up. Pew also found that 17% of lower-income homeowners reported having no homeowners insurance at all, compared with 2% of upper-income homeowners. That does not mean lower-income homeowners are unaffected. It shows a different kind of risk. Some may be less likely to report rising insurance costs because they do not have insurance coverage. That creates a separate concern. Lack of coverage can leave a household more exposed when damage occurs. For middle-class households, the pressure is often the premium increase itself. For lower-income homeowners, the issue can also be whether coverage is maintained at all. Insurance availability is part of the current story. Treasury found that non-renewal rates were about 80% higher in the highest risk zip codes than in the lowest risk zip codes. A non-renewal does not only mean a higher bill, it can force a homeowner to search for new coverage, possibly at a higher price or with fewer options. That can affect housing stability. A household may be able to pay its mortgage but struggle with rising insurance costs. A buyer may qualify for a loan but face a higher total monthly payment once insurance is included. A homeowner in a high-risk area may find that the cost of coverage is no longer a minor item in the housing budget. The timeline shows how the pressure accumulated. From 2018 to 2022, Treasury analyzed more than 246 million homeowners. Insurance policies from more than 330 insurers. During that period, average premiums rose 8.7% faster than inflation. Treasury also cited NOAA data showing $84 billion disasters, excluding floods, with costs above $609 billion. On January 16, 2025, Treasury released its report saying homeowners insurance was becoming more costly and harder to procure for millions of Americans. From 2019 to 2024, Gallup found the average U.S. homeowners insurance premium rose 3% after adjusting for inflation, while parts of certain states saw increases of 25% or more. From 2020 to 2024, Gallup found that state regulatory review times for premium change requests varied. Colorado had the longest median review time at 331 days. California had the second longest at 305 days. On February 27, 2026, GAO released its reports showing that premiums generally tracked inflation nationally but rose more in disaster-prone areas. From March 16 to March 22, 2026. Pew surveyed U.S. adults and homeowners about home insurance costs. On May 6, 2026, Pew reported that 71% of U.S. homeowners said their homeowners' insurance costs had gone up over the last few years. The sequence shows a cost trend moving through housing. Insurance costs rose faster than inflation in Treasury's data period. Higher-risk zip codes paid more. Non-renewals were higher in high-risk zip codes. GAO found sharper increases in certain disaster-prone areas. Pew found that most homeowners reported higher costs. There are important cautions. First, homeowners insurance does not usually cover flooding. Treasury explicitly excluded flooding because floods are not typically covered by homeowners insurance policies. That distinction matters because not every disaster risk is priced or covered in the same way. Second, national averages can be misleading. Gauss national average showed a 3% increase after inflation from 2019 to 2024. Some areas saw increases of 25% or more. A national figure can look manageable, while certain regions face severe affordability pressure. Third, the Pew data on causes reflects what homeowners believe is driving their premium increases. It is useful for understanding public perception, but it should not be treated as proof of any single cause. Fourth, regulation differs by state. Homeowners insurance is state-regulated, and GAO found that review times for premium change requests varied across states. The same national issue can look different depending on the state market. The current reality is clear. Homeowners insurance is no longer a small background cost for many households. Pew found that 71% of homeowners said their insurance costs had gone up. Treasury found that higher-risk zip codes paid much more and faced higher non-renewal rates. GAO found that national averages hide sharper increases in disaster-prone areas. For households, the unresolved pressure is affordability and predictability. A fixed mortgage can still come with a changing monthly payment if insurance costs rise through escrow. A home in a high-risk zip code can carry a higher insurance burden. A homeowner in a region with availability problems can face both price pressure and uncertainty about coverage. This is how insurance becomes part of the middle-class squeeze. The pressure begins with risk, claims, repair costs, rebuilding costs, and insurance pricing. It moves through premiums, non-renewals, and state-regulated insurance markets. It reaches households through annual bills and monthly mortgage payments. The company is not the protagonist. The consequence is. For homeowners, the real issue is not simply the price of a policy. It is the total cost of staying insured, staying in the home, and keeping a household budget stable. The mortgage may still be the largest housing cost. Homeowners insurance is becoming a hidden cost that more households can no longer ignore.